The Wall Street snaps its two-week gaining streak to record its biggest fall in 2 months. On the editor's roundtable, we discuss the FI positioning and the index movement. We decode whether the FIs have missed the Make in India bus. We'll also bring you the big EPS upgrades and downgrades, and we'll put the spotlight on the Fmcg stocks. I'm Rajesh Souza, and with me, it's a complete boys club today. Prashant, Anuj, as well as Nimesh. Welcome, gentlemen, and we have got Rahul Arora as well to join in. So, all boys club today. How are you feeling?
Well, it's good. It's a Friday, right? But as you said, all boys club. Of course, we're missing Sonia, but I think it's okay. I think Rahul is here, Nigel is here, so I think we'll make up for the
difficult to make up for Sonia, but
right?
we'll
glamour question, including the beer and the drinks.
No, but the market this week was quite tough actually, and this was one of those weeks where you were craving for Friday. It's almost like, when will Friday come and when will the markets close? And very, very tough week actually, Nigel, frankly, for the market.
Indeed,
Yeah, in
Nimesh.
fact, as everybody's been getting reports as well, massive selling by the FIIs, and there's been a lot of chatter about a couple of large hedge funds, liquidating a lot of India position, not only India position, but positions across Asia and emerging markets. So that's led to a lot of pressure as well. We've tested the crucial technical supports as well, so that got tested as well. But in general, I guess the other way to read this is before the big event on June 4th. If the market's a little light, I think it seems to be a blessing in disguise, right? So it's a bit positive as well that we are not getting too excited and going into a big event with so much of long position. So in a way, it's healthy that this correction has happened. Need to see how the next few weeks pans out because of next week Monday we have the fourth phase.
Yes.
Earnings are still on, and we're seeing huge reactions to the earnings as well. So it's going to be volatile, but till the time we take supports at crucial levels. And we just consolidate these levels, it should be good and fine before the fourth big event.
Well, that's right. And, Prashant, I'll be waiting to hear about the earnings picture, how that is
No one cares about earnings, so we're going to do that last. I think.
So we'll do that last. I think let's start off with the market action first, Anuj. And the FI setup is quite interesting as well. So tell us how you're reading the data points.
Nigel, first things first, our dependence on FI flows has obviously reduced.
Yes.
If we had this kind of numbers 5 years back, the market would have collapsed. So in that sense, it's good. The SIP number this time also was 21,000 crores thereabout. But I think what I'm doing is, while FIs have been selling on cash markets, in the F&O market, there's been aggressive short positioning. There's a graph that I've made now. We need to make some adjustment in this because the contract sizes have changed on the Nifty. But even then, if you look at the percentage numbers, we are now at, almost a record high short positioning. Now, that is interesting because, we've had this 3 or 4 times in the past. And I'll go by the last 2 years data because I think that's telling you a lot. We had the same situation in March 2023. And what happened in the market in that period? The Nifty fell from the top by about 10% or thereabout. I think some of the graphics will come up for you. Yeah. And after that, in the next 3 months, what was the return for the Nifty? 18%. Then we had October 2023. When the market fell, Nifty fell 7% when these short positions were taken by FIs. Over the next 3 months, Nifty returned 15%. I'm talking about Nifty returns, and this has happened in the past. Okay, this time we've already fallen about 4% on the Nifty. Let's see what we do 3 months from here on. I want to add another angle here, which is the India VIX. And, add the past indicator. The India VIX has risen from 10 to 19. Today, I think we closed at somewhere around 19. And last time when we had India VIX at 19 was in September, October 22. Actually, the markets normally have 2 tough months, May and October, right? And last 2 years have been like that. In October 22 also, we, crossed 19 and Nifty fell almost 6% from the peak. But after that, we again hit all-time high. And my sense is that sometimes, and most of the times in markets, these things repeat. So if I were to stick my neck out, my sense is that you'll have a new high and a significantly higher high at some point this year itself.
Okay, interesting. Rahul, let's get you as well into the conversation. How are you reading this? As Nimesh said earlier, if the markets are selling off a little bit ahead of the big event, and the outcome should obviously be in favor of the markets. Let's get continuity of the, of the current ruling government. It could be a blessing in disguise. Your take on the Nifty first up.
So thanks for having me on the show, Nigel. I think without wanting to get into specifics on why the market has corrected, I think this is a welcome correction. I think if we were to look at the stocks that we were tracking under our coverage, and particularly the more expensive ones, and we were looking at 5-10-year averages, most of these companies were trading at between half to 1.5 times standard deviation above mean. So valuations were not supportive to begin with going into the result season. Right. And the stocks were not only priced for perfection, some of these were priced beyond perfection, right? And I think when you have those kind of valuations, the room for error is very little. And you've seen that in the result season so far. I mean, there are not too many companies where you've got significant 10-15% kind of earnings upgrades. In fact, in some you've got 10-15% earnings downgrades. And I think when the dust settles and we take a look at upgrades to downgrades, I think my hunch is that eventually at the end of the result season, you'll probably have more downgrades than you'll have upgrades. My big worry, Nigel, is though while consumer companies are talking about volume growth returning, I think margins have topped out across the board for corporate India. So it is going to be top line that is going to have to deliver. And if that doesn't happen, even if the market was to rally, say, post the event, I don't know how much of that would probably be sustainable, because we've had a remarkable 2-year base, such a depressed base of 2 years on which everything has grown. I don't know what kind of incremental levers we have from here. The only thing that can support the market is the fact that your flows, domestic flows, keep coming in. But at that point, there's a tipping off point for everything. I think
that's a big call that you're making. You're saying that from here on, the EPS growth that we had because of the margin uptick, that would slow down.
Absolutely, Anuj. I think you look at, let's take a look at the sector of the week, right? Consumer. Lever was operating at 13-14% margins a decade back. Today, that's 25. Is 25 going to go to 30, 35? I don't think so. I think most consumer companies have topped out. IT companies' margins aren't going anywhere in a material fashion. NIMs in banks are contracting. So that's what, if you exclude Reliance, that's 60% of the market right there. So if 60% of the market isn't going to see margin expansion at an aggregate level, how are you going to see? I believe you tracked cement closely. I mean, just look at the misses on EBITDA per ton that is happening on cement, right? So where is that? At an aggregate level, where are you going to see margin expansion coming from? That's the question. If it's not going to be top line driven, I think the market is going to have a challenge in terms of sustaining earnings. I think the biggest problem with the market, Nigel, is every year you can go back and you can speak to these gentlemen across the dais here. For the last 15-20 years, I've seen every year the market starts over the 15-20% earnings growth and then comes down to mid to high single digits. And I think it's just such a I think somewhere the broking community needs to take responsibility for, and I'd go a step further saying misguiding. I think you need to be a little more realistic in the way you project things so that people don't lose money on your recommendations. But even if, as Anuj was saying, even if you get the short covering on the, on the future side, or you do get some follow-on buying, I think it's going to be challenging to sustain those valuations in the near term.
Oh, absolutely. I think all of us need to be a bit more responsible, brokers, media, everyone. But staying with FIIs, now there's a very interesting question that we are asking today. And in fact, we are asking this question to Nimesh. Have the FIIs missed the Make in India buzz? Nimesh, of course, I was privy to the research that you had sent that you're going to present right now. It looked fascinating. Why don't you take us through that?
Anu, just to say, the sense that Make in India was the biggest wealth creator for the last couple of years across segments, right? Whether it's the defense theme or the railway theme, or for that matter, the capex theme. But the key question is whether the investors and analysts at large miss the whole buzz. Let me just go to the wall and explain why I'm saying this. So the big question is FIIs and the investor community at large miss the Make in India buzz? Now, there's been a big, huge wealth creator for a lot of investors in the last couple of years. So I just came across some big, interesting reports from larger FI brokerages in this last few days. Nomura put out a big report on defense this week. It's a 100-page report, and they say that they see a $140 billion opportunity in the defense sector in India over the next 10 years. So that's a big opportunity in the defense side. The next big report, which came from BofA Securities, they actually upgraded a couple of industrial names like Siemens and ABB, and they see a $450 billion of capex that can come across to these companies over the next 8 to 10 years. So again, a big number as far as big capex opportunity for these companies in India. The third was on the railways. Morgan Stanley put out a big note on the railway. They see a big revival in the railway capex, and they had actually initiated coverage on few companies as well. And similarly, there was a big report maybe 4 weeks back from Goldman Sachs on the power sector. They see a big opportunity even in the transmission space in India. So look at the stocks that I'm focusing on. Nomura put out a note on the defense sector, and they put out an initiating report on both HAL as well as on BEL both with the buy ratings. ABB and Siemens both are actually upgrade the stocks to buy from neutral, and they have now given a multiple of close to 75 times on both these names. Similarly, Titagar Wagon, Morgan Stanley put out a note on the railways, and they had initiated coverage on the stock with an overweight rating and a target price of another 25% upside from current levels. Similarly, Hitachi, Goldman Sachs had put out a note with the initiating report just 4 weeks back, and they see a huge potential upside for Hitachi as well, even from current levels. But the key is look at the kind of performance these stocks have done, the wealth that these stocks have created in the last 2 and 3 years. Hindustan Aeronautics HAL, it's up 8 times in last 2 years, and it's up 15 times in the last 3 years. I'm talking about 15x returns in the last 3 years for HAL. Similarly for BEL, the stock is up already 12x in the last 3 years. ABB is up 9x. Siemens is up 6x in the last 3 years. Titagar Wagon, there is an initiating report from Morgan, but that stock is already up 33 times in the last 3 years. Similarly, Hitachi Energy, where the stock has gone up 12 times in the last 3 years. So this has been a huge rally we've seen in these names, and now we are seeing big reports as well. Having said that, while everybody agrees to the big opportunity which is there, a big total addressable market, but even in terms of valuations, we've seen a lot of catch up in these stocks as well as far as valuations are concerned. Hindustan Aeronautics is now trading at 40 times versus the 5-year average of 20 times. Similarly, BEL now trading at 40 times versus 10-year average of close to 30 times. ABB is now trading at close to 90 times on FY25 earnings, whereas the 5-year average has been 87 times. Similarly, Siemens at 81 versus 5-year of 71. And Titagar is trading at now 45 times on FY25 price to earnings. So the key is, while the addressable market could be quite large, but we've already seen a huge rally in all these Make in India companies, whether it's defense, whether it's aerospace, all of stuff done really well. So the question is whether a lot of investors and analysts miss the bus in terms of the Make in India theme. Rahul, you've been tracking defense and you've put out a note as well at Nirmal Bang. What's your sense in like the likes of BEL and HAL at 40 times? Is it easy to convince the investors to buy the stories now?
On a lighter note, our report was 155 pages. But no, that
per page, per page productivity, per capita.
Yeah, no, but I think the interesting part of that report, I don't know if you guys had a chance to read it, it's actually co-authored by the ex-MD of BML.
Yes.
So it's actually there is no defense report in India that is, it's a very differentiated report from that angle. But that being said, I think your point is well taken. I think there are 2 or 3 points here, Nimesh bhai. I think what I would have liked to see in your link would have been sales growth also.
Yeah.
Right? You'll see that sales growth has not kept up with the stock price growth. So it is a lot of the future opportunity that you've captured without actual deliverables. The same thing happened in the chemical sector in India when the lockdown started. If you see these same names, right? Naveen, SRF, Galaxy, Rosari, Aarti, they're all gone up between 5 to 10x when it had started. This entire China plus one theme. There was no growth in sales, but you bought the hope. The question now is, once this indigenization does happen, and you do become, as the Prime Minister says, Atmanirbhar, the point is, who is the largest buyer of these products? It's the government of India. So if you can make the product and you can keep it in your warehouse, the problem is that your working capital and your balance sheet will fluctuate a lot because the final offtake has to be taken there. So cash flows could also vary. But the point is, over a period of time, if you do reach, say, 10% indigenization, 15, 20%, the numbers will actually start to, show up. And then your valuations will look reasonable because it's a numerator-denominator game at the end of the day. And I'll take you back to a classical story of a stock that I've been very bullish on for a very, very long time, which is Westlife. It was a loss-making company for the longest time. So it looked at very absurd multiples. But today, even though the multiples are still absurd today at 50 times, but it's looking far better than it was a few years back at 120, 130 times. So I think once the numbers start coming in, then this will look a lot more rational because I think the story of revenue growth is going to begin now.
Yeah.
That is where, I think the stocks have gone too far out.
And the addressable market is quite large. We all know that there could be a large opportunity in terms of revenue growth for all these companies. But the fact is that already the stocks have rallied so much. HAL is up 15 times, BEL is up 12 times.
The way I look at it, Nimesh bhai, is don't buy these stocks for 10, 15, 20% now. Yeah. If you're buying it, try and have a horizon of about 5-10 years to be holding this. Like hold it like you would have held a Bajaj Finance or an HDFC Bank or a Hindustan Lever. And then take a look at your returns. Because if you buy these right now, near-term disappointment chances are higher than actually near-term positive surprises.
All right, interesting. So big opportunity out there. The stocks have rallied, but over a longer span of time, maybe in fact, there could be some entry opportunities out there. Well, let's focus on earnings. Prashant, take it away. A lot of companies have already reported hits, misses. How are the earnings stacking up?
I mean, it's a little mixed, actually. I'm looking at the NSE 200 group of companies. So actually, let me just go across and explain. what we're trying to do here. So we do this every quarter. Right now, basically 50% of the companies were reported from the NSE 200 basket. And what we're doing is looking at the fourth quarter earnings then based on the fourth quarter earnings, looking at how consensus F525 estimates have changed. How many companies have seen upgrades, how many have seen downgrades. So as I said, out of the 200 companies, 104 have reported. Of course, this is as of yesterday, and this is all data from Bloomberg consensus estimates. 51 companies have seen downgrades, 42 have seen upgrades. So more downgrades than upgrades, and the rest, of course, have not seen any change, meaningful change at all. So we've kind of excluded that. Now, I'll just start with upgrades and the good news first. Although the absolute number of companies which have seen upgrades is lower. And this is, the top companies. What I've tried to do is I've broadly tried to bunch things together, in sectors or broad baskets or adjacent sectors. So PNB has seen I checked with our colleague Abhishek who tracks banking whether, post PNB numbers estimates have been taken up. Well, he did say some 25-30%, but the number which I got from on a consensus basis is 70% up for F525 estimates. Vedanta has seen a 26% upgrade to consensus estimates. And by the way, all these changes are over the last 1 month. And why 1 month? Because we are basically taking a period right before the earnings season started from that point to now. So it kind of captures the earnings impact. So Vedanta has seen a 26% sort of upgrade to earnings for the full year 25. Coal India has seen an 8% upgrade. Tata Power has seen a 5.5% upgrade as well to full year estimates. Look at some of these sort of names. Trent has seen an 11% upgrade to 11% upgrade to earnings. You've got Macrotech has seen a 7%. There you go. That is Loda. And they've got Bajaj Auto, which has seen about a 6% upgrade to FY25 earnings as well. Oracle Financial Services, Oracle Finance and Indus Tower are some of the others which will come up on your screen as well. And there is the entire financial space, HDFC Bank, Indian Bank and HDFC AMC, which have also actually seen upgrades to full year estimates. On the downside, as I said, more downgrades than upgrades, but Piramal has seen the largest downgrade, 21% downgrade to full year estimates. ICICI Pru has seen a 14% downgrade. MRF has seen a 13% downgrade. Dalmia Bharat, Tata Chemicals in the 11% range. A lot of technology companies have downgrades as well. So there is Tech Mahindra, Coforge, L&T Technologies, anything between 6 and 8%. And to wrap it up, Godrej Properties and Loris Laboratories are some of the others which have seen downgrades as well. So, that's the set. Only 104 out of 200 have reported as of yesterday. And of course, the pace will pick up in the coming days. And hopefully, we'll kind of balance it out and maybe, fingers crossed, it won't be as mixed as it is right now. Overall, earnings season seems to be a little underwhelming, as Rahul was also mentioning. Guys, back to you.
So, Rahul, just to take this forward on the earnings, within the coverage that you all have, anything that stood out for you on a big beat, or maybe something which is like a big disaster as well on either side?
So I think in terms of, I wouldn't say disaster, I think the biggest letdown has been IT. I think because Girish was anyway the lowest on the street, and when the lowest person on the street has to revise his numbers lower, it's a bit disconcerting. So I think that was probably the most disappointing. I think just the commentary coming in from consumer has been all right. I don't know how much of that is fructified. Double-digit volume growth is a very, very tough ask. Double-digit revenue growth itself is a very tough ask, but double-digit volume growth. But the commentary has been good. And I think in pockets, if you look at the mid-cap space, I think the AC players haven't been too bad. I think if you strip out the loss that Voltas had to take in its non-AC business, it was all right. Blue Star had a phenomenal set of results. I haven't gone through Polycap's numbers today, but I remember over the last few quarters, it's been one of the stocks that has seen one of the largest upgrades, so to speak. But otherwise, like I was saying, I think broadly it's been a bit on the lower side. I think in terms of banks, IndusInd I can remember has seen. But again, it's not been like a consensus, everything has sort of been upgraded. But I think the biggest positive surprise would be consumer, biggest negative surprise would be IT. And on the mid-cap side, I think the biggest positive would be, say, something in the room AC space, names like Voltas, Blue Star and the likes. All
right, noted that point, Rahul. For the time being, though, we'll slip into a short break. Coming up next, we continue to decode the market gone by. And we'll put the spotlight on the FMCG stocks. Stay tuned. Welcome back. You're tuned in to Editors Roundtable. Well, it's time to put the spotlight on the FMCG space. And Rahul, I want your opinion on this, because I recall a couple of times ago we asked you, what about the consumption slowdown? You said it's not a slowdown, it's the way India's consuming has changed. But let's put up all the data points first up for our viewers on the screen. FMCG was the sector of the week. You'll say, how come it's a sector of the week? The index itself is up only around 1%. I'll tell you what, ITC out there, well, that's the largest weight on the FMCG index. It has 35% of weightage. And for this month, it's down close to 0.5%. That's why that FMCG index is not looking like it's moved a lot. And the smaller names have moved the most. Britannia, Dabur, Marico, between them, they have only 7-8% of the FMCG index. Let's run you through the data points. What played out in the past week in particular? The commentary on the rural economy was very, very encouraging, and that's after very, very long. Some of the management's talking about green shoots. We also heard a couple of managements say that rural business, well, it outpaced the urban business, and we haven't heard that for the last 3 years or so. That's what some of the sell-side reports suggest. And now we're bracing for a good monsoon. So that's one point, rural economy coming back. The next point is they're suddenly talking about growth, whether it was Dabur, Britannia, Godrej Consumer. They're talking about high single-digit growth. Some of them are talking about some price increases as well. So growth is coming back. And after a while, even Britannia on the call sounded very, very optimistic. Point number 3 is the premiumization. Well, that seems to be a structural story that's playing out there. And, as India moves from, bottom of a pyramid consumption story to maybe a mid-income country, you're going to see the premiumization theme that picks up pace and grows at a faster clip as well. And we are at a nascent stage out there. So that's another point. And margins could look up. Operating leverage, as I told you, premiumization as well will play out. And there will be some kind of inflation which will help in the selling price. So some inflation in the system is good, actually. So you'll have some volume growth coupled with some price increase, which will brace ourselves up for revenue growth in double digits. Now, elections, well, that's the core point, right? Everyone's talking about elections. And having a longer election, particularly in summer, isn't such a bad thing. And some brokerage reports suggest that maybe, in fact, the positive outcome of this election could show up in the Q1 numbers with growth, with margins. Under ownership is another theme, because if you look at FIIs and DIs, well, they have close to 5 to 6% of their weightage to the FMCG space. And FMCG sector in the Nifty 200 itself is close to 7.5%. So there is a bit of under ownership out there. And let's wind this down with a valuation chart. You look at Dabur, HUL, Nestle, as well as Tata Consumer. In comparison to what they've traded at in the last 5 years on an average, they're trading relatively lower. Well, that's about all the points, Rahul, that fired up some of these stocks. What's your view on these FMCG stocks? Out of nowhere, a Marico, a Dabur, rallying 10%, almost 10% in a single session. Even Britannia was up. Would you jump on, or do you think the market's running ahead of itself?
No, so I think since it's a Friday, you should have plotted the alcohol stocks
No,
over
that I did last week. That I did last week,
It's
actually.
been the best performing consumer sector. I think if you look at Radico, Globus, United Spirits, United Breweries, Sula, all up between 40 to 60%.
Let me turn it around then. Between FMCG and the alcohol beverage companies, what would you prefer? The alcohol beverage companies have done far better. The Radico, United Spirits, United Breweries. Do you think you still tilt towards them rather than go for the FMCG names?
Okay, so I'll answer this in 2 ways. Earnings growth will be better for Alcobev over the next 2 years compared to consumer staples. But I think consumer staples as stocks could potentially do better because of the under ownership factor. I think you've definitely in the last 1 week seen a shift from IT to FMCG for sure. We generally tend to do this analysis and I haven't got the exact numbers, but I'm pretty sure when we look at the fund movement, you would have seen some movement away from banks and IT into FMCG. Barring ITC, like you said, and that's probably the reason you saw ITC also lower this week, because ITC has been very heavily over-owned.
Yes.
If you remember when the run in ITC started, it was trading at about 25, 26 times multiple. That has got reset in a very big way. So that is ownership. But if I was buying earnings, I think if I look at a United Breweries, it's going to do what, a 700 crore EBITDA or something like that is what it did this year. Our call is that it's probably going to go to at least 2.5x in 2 years. And if you look at most consumer companies' valuations, the likes that you listed, were between 40 to 45 times, the names that you took.
Yeah.
Historically, when FMCG companies' earnings compound at 15%, these guys can trade between 50 to 55 times.
Yeah.
So there is a 20% trade there to be made. So I think if I was playing it through stocks, because I think if you look at most of the Alcobev stocks, including UNSP and United Breweries, you'd be trading at very, very high multiples right now. They'll be close to 55 times already, 50, 55 times. So I think staples presents a better opportunity in terms of stock price appreciation because of the under ownership. But earnings is definitely going to be happening more on the discretionary side, particularly in Alcobev.
Well, appreciate you joining in, Rahul, today and discussing all those sectors as well as themes with us. So wishing you a good weekend, and we discuss alcohol beverage companies. So let's get straight to that. For the time being, we'll wrap up on this edition of Editors Roundtable. Thanks so much for watching. Stay tuned. More news and updates on the other side.